Hey everyone, welcome back to Fibonaccis-Traders. Today, we're unlocking one of trading's most intriguing secrets. Why does price action seem to dance to the tune of Fibonacci retracements and trend lines? If you've ever wondered how these seemingly simple tools can predict market movements with such eerie precision, you're in for a treat. Get ready to explore the synergy between nature's numbers and market psychology and discover how these patterns can transform your trading strategy. Let's get started. Understanding Fibonacci retracements, Fibonacci basics. The Fibonacci sequence is a mathematical phenomenon where each number is the sum of the two preceding ones, 0, 1, 1, 2, 3, 5, 8, 13, etc. In trading, the key Fibonacci ratios 23.6%, 38.2%, 50%, 61.8%, and 100% derived from this sequence are used to identify potential reversal levels. These levels are thought to represent natural support and resistance points where price might bounce back or reverse, reflecting the innate human psychology of trading at these points due to their widespread recognition. Application in trading. Fibonacci retracements are used to predict price pullbacks in a trending market. When a market moves in a clear trend, either up or down, traders use these levels to anticipate where the price might correct to before continuing in its primary direction. This method helps in setting entry points for trades with a higher probability of success, especially when combined with other technical indicators. The role of trend lines, trend line dynamics. Trend lines are simple yet powerful tools in technical analysis, drawn between significant price points to highlight the direction of price movement. An upward trend line connects lows, suggesting support, while a downward trend line connects highs, indicating resistance. These lines help traders visualize trends, making it easier to anticipate future price movements based on past behavior. Combining with Fibonacci. When trend lines intersect with Fibonacci retracement levels, they often reinforce each other, providing stronger signals for market entry or exit. For example, if a price retraces to a Fibonacci level and also touches a trend line, this confluence can be interpreted as a very high probability area for price to react, either by bouncing back in the direction of the trend or breaking through, signaling a potential trend change. Psychological and self-fulfilling prophecy, human behavior and market. Psychology, the effectiveness of Fibonacci retracements and trend lines in predicting price movements can be attributed to a self-fulfilling prophecy. Because so many traders watch these levels, they place orders at these points, thereby influencing the price action. When many traders set buy or sell orders at the same Fibonacci levels, these levels naturally become areas of significant price movement. Confirmation through volume and other indicators. To make these strategies more convincing, traders often look for additional confirmations. High trading volume at these Fibonacci levels or trend line touches can confirm the strength of these points. Combining these tools with indicators like MACD or moving averages helps in filtering out false signals, providing a more robust trading strategy. Empirical evidence, historical market data, numerous charts from various assets like Forex, stocks, and cryptocurrencies illustrate how prices often reverse or pause at Fibonacci levels during trends. This pattern is observable across different time frames, although it's more pronounced in trending markets. Trader testimonials. Many traders share their experiences on platforms like X, where they discuss success stories involving trades based on Fibonacci levels and trend lines. These anecdotal accounts, while not scientific proof, add to the narrative of effectiveness in real trading scenarios. Conclusion. The synergy between Fibonacci retracement levels and trend lines lies not just in their mathematical beauty, but in their practical application in trading. They offer a logical framework for understanding market movements, supported by trader psychology and collective market behavior. However, like all trading tools, they should be used as part of a broader strategy that includes risk management and other technical or fundamental analyses. This explanation provides a compelling overview of why price might follow these mathematical and visual cues, emphasizing their practical use in trading strategies. Thanks for tuning in to this deep dive on how Fibonacci and trend lines guide price movements in trading. If you found this video enlightening, make sure to give it a thumbs up, share it with fellow traders, and subscribe for more content that unravels the complexities of the financial markets. Drop your thoughts, questions, or your own trading experiences with these tools in the comments below. Until next time, keep your charts close and your Fibonacci levels closer. Happy trading, everyone.